In this episode, we're going to talk about market data. I'm going to show you bars and graphs and things like that. To be more specific, it's going to be about Northeast region of Pennsylvania. So anyways, let's look at some trends, let's study some things, and let's get right into it. So let's go to January. We're here in February of 2023. We're looking at 3 years right now. And if you look here, the medium sales price was $155,000 in January of 2020. The average sales price was $173,000. Let's stick with the medium, $155,000. In 3 years, guys, we went from $155,000 medium to $262,000. That's over $100,000 in valuation. So that's $35,000 in equity per year, every year since 2020. Just think about this logically. Was that sustainable in the long haul? We now know that, right? If any thinking person would have known that was not sustainable, as people's incomes was not keeping up with the equity and the price valuations going up, right? If we go by medium, the medium price was $280,000. Now look at what's happening here. As of January, it's dropped to $262,000. We are now back to where we were. If we go back to last January of 22, January of 22, the prices were $245,000. February of 22 is $253,000. I am willing to bet that for this market here in the Northeast, we're going to see lower. If not, we're going to go back to the prices that we were in February of 22. Now, this is a report I just ran on the MLS. We have sold 75 properties so far, medium of 229. The average sold price is 215. Here's what's interesting. You have 141 pending, which this is good. 136 new, 141 pending. A lot of them are back on the market. You got 32 that went back on the market. Active in range, 1,600. We're going to talk about inventory in a minute here. But if you see this now, granted, this is a short month. We have another 18 days or so, 17, 18 days for more deals to close. But look at these numbers. Medium 229, average 215. That's drastic. Now there's still time left. I have a funny feeling that we're going to wind up somewhere between 245 and 250 in this market, which if that's the case, and we look at February, we are declining, we're descending. When did we peak, right? Based on this graph, we peaked in June of 2007, 185. But look at what happened, right, guys? It's just a straight line going down. And we bottomed out, not in February of 2013, but in March of 2015. The point here is that a lot of people think that a market crash occurs in one shot. A market crash does not happen. Today we're at 200,000 and then tomorrow we drop 10%. No, that's not what a market crash looks like. This is what a crash looks like. It's a slow drip of 0.5% a month, 1% a month, another 1% a month, 1% a month, another 0.5% a month. That is a shock to a lot of people. A lot of people don't understand. Real estate is very slow. It's a slow moving train. So now I want to bring us here. We peaked here. If we go by medium, if we go to average price, was a lot higher. Bottom based on averages was February of 2015. And then you can see the clear. From there, it just kind of went up, right? You see the clear line. We peaked here in the Poconos, Northeast Pennsylvania in April of 2022 at 307. Look at where the price is today, 281, right? So if I take 281, we've lost 9% from April to January. That's what a crash looks like. It's a drip, drip, drip. And I'm not saying that it's going to continue to go down. I'm not suggesting that. What I am suggesting, though, is that when I look at the data, we're obviously seeing it. As interest rates continue to go up, guys, we're going to see continuous pain. As I record this episode right now, February 11th, as I record this, the interest rates ticked up again. The 10-year treasury is again back to October's numbers. The 10-year treasury this morning is 3.74, the 10-year treasury. That's what actually impacts a 30-year mortgage. We are today, I just looked at what it is 6.89 for a 30-year mortgage conventional. The highs was October of 22 and it was in the sevens. The week before, last week, interest rates were an average of 6.19 as per Redfin. I have a funny suspicion that the interest rates are going to be significantly higher when the data comes out and I put out my weekly market data report next week. So guys, what does that tell us? That tells us, man, as the interest rates continue to climb, right, and inventory sits on the market, the medium average days on the market was 50 days. That was up 34 days from the 18-day low in May of 2022. Yet right now in February, again, it's only the 11th, right? It's only February 11th. The average days in the market is 90 days. As that continues to go up and interest rates continue to go up and inventory continues to creep up, prices have to continue to come down. So be careful, guys, pay attention. Buyers, this is a great opportunity. The market has completely shifted. It is a buyer's market. What I will tell you is that I think prices will continue to climb down. We're starting to see some cracks also in the rental space, where we've seen the lowest rental increase that we've seen in a few years. And I think it's been 2%. It's really, really conservative, which as an investor, as a renter, I'm good with that. Even if it stays flat, I'm good with it if my places are occupied. Here, closed sales. Look at this. Look at this. Real estate agents are starving. Look at what's happening, guys. 249 closed deals. That just tells you real estate agents are leaving the industry by the droves. I mean, they're just getting out. There's 3,000 agents, licensed agents in this region, in the Poconos Mountain region, and there's only 249 deals closed. Look at where we are now. You're seeing the correlation of inventory down. When inventory is down, prices go up. As inventory goes up, prices go down. Why? Because buyers have a lot more options. Now let's look at it in terms of your actual data. Anyways, guys, I appreciate you guys watching. Make sure you share this. If you like this content, it really helps with the algorithm, and let me know what kind of data you want me to share with you. Again, a market crash does not happen overnight. For those of you that think that there's no crash coming, and I'm not saying a crash is coming. I hope not, because I'm in this business. It's gonna be very painful for a lot of folks. But what I am saying is that the data is showing that values are definitely declining. There is no question about that. How far they're going to go, we don't know. I think a crash is 20. Anything over 20%, I consider a crash. I could tell you that right now, from the peak to now, here in the Poconos, it's about between 7 and 9%. We just saw it. We just kind of ran the numbers here. If that happens again in 23, will be a tough year with those trends. Now, that doesn't mean that the past is an indication of the future. It's just data. It's just data. Take the data, analyze yourself, be a thinking person, decide, you tell me what you think it is. Drop it in the comments, like, share, subscribe. We really appreciate that. Peace out. Hey guys, thanks for watching this video to the very end. If you want to continue to watch videos like this one, click this video right here. I think you would enjoy that. And if you want to continue to learn from me and learn how to create wealth through real estate investing, check out my online course. It's in the links below. It's how to get your first off-market deal in under 60 days or less. Thanks again for watching. Really appreciate you guys. Peace out.